Today we continue with the last part of the financial market. Now let's flash back a little bit before we move even further. Now if you guys remember, we defined the financial market and conclude that it offers a platform for buying and selling of financial instruments, right? So the financial market literally offers a platform for trading of financial assets, and we mentioned a number of financial assets such as bonds of all types, treasury bills, commercial papers, etc., etc. And speaking of bonds, the other day I mentioned that we have treasury bond and we have corporate bonds, right? Now, again, a bond can be callable, right? A bond can be callable. That means the issuer or the issuing company can recall back the bond before maturity. That's what we call callable bond. Okay, with a callable bond, excuse me, with a callable bond, it means the issuing company can recall the bond before maturity. Okay, the issuing company can call the bond before maturity. This is for the callable bond. For example, if a callable bond is supposed to mature within 5 years, okay, if a callable bond is supposed to mature within 5 years, and for some reasons the issuing firm had decided to cancel off the bond before the completion of 5 years, with the callable bonds it is possible. Okay, that means the company might decide to pay you, let's say, in year 4 or in year 3, depending with the circumstances of the situation that have warranted the company to recall back the bond. Okay, but then we have convertible bond. Okay, now what is a convertible bond? Convertible bond simply means a bond that can be converted into share. This bond can be converted into a share. Okay, we all know share or stock. Okay, that is to say, with a share or stock, you become a partial owner. You become a partial owner of the issuing company. If you own a share or stocks of a certain company, you become a partial owner of the issuing company. In other words, you become a shareholder. All right. But with a bond of any type, you are simply a creditor of the issuing company. A bondholder is simply a creditor of the issuing company. No voting rights, you cannot attend general meetings, etc., etc. You see, you are simply a creditor, no different with a bank that has just offered a loan to the same company. Okay, that is your status. Now, a bond of different maturities can be, a bond is of different maturity. Bond can mature within 2 years, 5 years, 7 years, 10 years, 15 years, 20 years, and up to 25 years. These are different maturities of the bond. Okay. Now remember, if you are a bond holder, you are entitled to coupon payment. If you're a bondholder, you are entitled to coupon payments, and in most cases, these coupon payments are payable twice in a year. That is, after every 6 months, right? Every 6 months, you are entitled to be paid certain coupon payments as per the agreement, and the coupon payments will follow what? The coupon rate, okay? The agreed coupon rate. Again, if you are to receive coupon payment, or if you are a bondholder, it does not matter whether the company has made a profit or loss, okay? It does not matter whether the company has made a profit or loss. A coupon payment must be made. The company must honor its contractual obligations, because I've just told you bond is not different from a bank loan. So a borrower needs to ensure that they repay or they meet monthly repayment of the loan. Now, just like in the loan, with a bond is the same. The issuing company needs to pay the bondholder coupon payments regardless of whether the company has made a profit or loss. This is different from share. If you own share, you are entitled to dividend, okay? If you are a shareholder, you are entitled to dividend. But dividends are issued only if the company has made a profit and decided to issue what? Dividend. All right, so there can be a decision and also a profit needs to be made. In case the company made a profit and decide not to issue the dividend, then shareholders do not need to worry. They have to remain silent. Again, in case the company has suffered loss and so it can never issue dividend, then shareholders need to remain silent. Rather, they will ask, like, what are the reasons of massive loss, and try to come up with some solution for the company to do better in the coming years. Okay, but with a bondholder, it's a different case. Okay, a company needs to find a way to pay the coupon payments as per the agreement. Now, what if the business cycle is too bad? Okay, or maybe the economy is about to get into the recession, to the extent that the company has come into conclusion that it can no longer meet its contractual obligation as per the bonds that have been issued. Let's say we have a bond that will mature in 15 years. Okay, and the company have concluded that the business is too bad for the company to meet these coupon payments as per the agreement. The company may decide to convert the bond into share. So the company can change this bond into share. And what do we do? Basically, what happens in simple mathematics, what happens is, for instance, if this bond will mature in 15 years, and we have, let's say, 12 more years before the bond will mature. That means we are talking of 24 coupon payments. Okay. Now all you have to do is to take the value of the bond plus the remaining coupons. Okay. After determining the value of the bond and the remaining coupon, then you use that amount to assume that the bondholder is now buying shares of the company. That means now we need again to obtain the current stock price. Okay, we need to obtain the current stock price of the company. Now, if it is determined that the value of the bond and the remaining coupon is, let's say, 100,000 USD, and stock price of the same company is, let's say, 50 USD, then this value can be used to purchase what? The stock price. That is to say, if you divide 100,000 by 50, you're going to end up with how many stocks? 20,000 stocks. So by doing so, this bondholder is officially becoming a shareholder. Right? That's number one. The bondholder officially becomes the shareholder. But number two, the bondholder can no longer demand what? Demand coupon payments. Rather, he or she will receive dividend. So this is done with the convertible bonds. Okay. Now, back to the financial market. I said that the financial market offers a platform for buying and selling of financial instruments. Now, financial markets can be the money market or the capital market. We saw that money market offers a platform for buying and selling of financial assets whose maturity does not exceed 1 year. So this market offers a platform for trading of short-term maturing securities or instruments. And what are the examples of these instruments? Can be commercial paper, can be certificate of deposits, can be banker's acceptance, can be repurchase agreement, can be a treasury bill. Right? These are some of the financial instruments that are traded at the money market. All these instruments have one thing in common, that is, their maturity does not exceed 1 year, that is 365 days or 12 months. The attribute of this market, we say it is high liquid, but also less risky. Now, since it's less risky, the higher the risk, the higher the return. Then, since it's less risky, then expect to earn lower return than the return that you can earn from the capital market. Now, what about the capital market? The capital market, this one offers a platform for trading of long-term maturing financial assets. Okay, that is to say, all financial assets trading at the capital market has maturity that exceeds 1 year. Okay, maturity exceeds a year. The capital market is intended to raise funds to meet business capital expenditure. If the company wants to launch a new product, okay, or the company wants to open some new branches, etc., then the capital market is the right place to go and raise such capital. Now, the capital market or instruments traded at the capital market are such as bonds of all types, stocks of all types. Again, there are different categories of stocks, okay, like preferred stocks, common stocks, redeemable stocks, irredeemable stocks. Okay, so there are also different categories of the stocks. All right. We can as well find debenture, syndicated loan, right? Mortgages. These are all products of the capital market. Now, the capital market is further subdivided. Okay? The capital market is further subdivided into the primary and secondary market. So, this is what I want to discuss with you today, and then we continue with something else. The primary and secondary segments of the capital market. Now, let's see the primary market. What is it? A primary market facilitates the issuance of new securities, thus provide funds to the initial issuer of the security. A primary market is a market of issue. This is a market of new issue. What do we mean when we say new issue? If company XYZ, for example, for the first time has decided to issue or to sell stocks at a certain market, financial market, okay? So pay attention here. The stocks of the XYZ company are going to be sold at the first time, for the first time, okay? For the first time. Then this sale will take place at the primary market. That's the reason we say the primary market is a market for a new issue of the financial instruments. Okay. So, if a new bond has been issued or some stocks have been issued, then for the first time, the sale will take place at the primary market. Now, the issuing of new stocks, okay, is commonly known as initial public offering, IPO. Initial public offering. So, if someone asks you, what is an IPO? Where does it take place? You know, IPO simply means the instance of the process whereby a certain company issues stocks for the first time at the financial market. By doing so, that company will be listed, officially listed at that financial market. Fund that will be raised through the IPO goes straight to the issuer of the stocks or to the issuing firm. Okay, funds that will be raised, okay, during the IPO or at the primary market, straight go to the issuing firm. if I'm to take you back, okay, if I'm to remind you, when you examine the Dar es Salaam Stock Exchange, you will find currently there are almost 32 listed companies. Okay, there are 32 listed companies. All right. And again, I should tell you this. For example, if initially the company used to be called XYZ Company Limited, okay, the moment it goes public, if I say it going public, it means now it has issued stocks for the first time, the IPO and get listed at the financial market. Now, the moment it goes public, the name will change. It will become now XYZ PLC. Okay, XYZ Public Limited Company. Now, we all know that National Microfinance Bank is listed at the Dar es Salaam Stock Exchange, so it's NMB PLC. CRDB likewise, it's CRDB PLC. KCB, it's PLC. That is to say, these three companies or these three commercial banks at different times over the past years, they went to the Dar es Salaam Stock Exchange and execute an IPO, where the three companies in different time sold some stocks for the general public to purchase. Whoever purchased stocks of these commercial banks, automatically they become the partial owner. They become the partial owner of these commercial banks. Therefore, simply call them their shareholders. There is a process, okay? There is a process for the IPO. That is, a company needs to find an appropriate underwriter. Okay, and an underwriter can be an investment bank, security firms, okay, or any other financing firms. It depends with their functions. So the company or the business needs to find an appropriate underwriter. The underwriter will evaluate the company, okay, and also the underwriter will propose three prices, okay, three different prices that a stock of the company will be sold during the IPO. Finally, they will prepare a prospectus, and this prospectus will be submitted to the regulatory authority of the underlying financial market. For example, had it been in the US, that will be Security Exchange Commission. But in Tanzania, that will be CMSA. Now, the regulatory authority, after going through the entire process, will finally approve the issuing of those stocks or shares, and also will set a price, will pick one price. Remember, the underwriter will propose three prices to be used, but the regulator will simply choose only one price. That will be a price per share of the assets. Then IPO will start, and it will go through for a number of days. It can be from 5 days up to 14 days. It depends. Okay. However, an extension can be requested. Okay. Now, during the sale or during the IPO, during the sale of these financial assets, to be precise now here, of these stocks. Different firms can participate in selling, in marketing and selling of these assets. In the recent years, you must have seen some commercial banks, particularly CRDB, participating in the selling of some financial securities, likewise NMB. I remember when Vodacom was selling their shares, CRDB participated very much. Okay, so not only investment banks can participate in marketing and selling of these shares, also even commercial bank can participate in doing so. The money that will be raised, fund that will be raised, will go straight to the issuing company. The fund that will be raised goes straight to the issuing company. In the prospectus, a definite number of shares to be issued will be stated. For instance, 2 million shares. Okay, so the number will be stated. And as I mentioned earlier also, the share price will be determined. Let's say 800 Tanzanian shillings. Okay. Now, if we have the exact price of the share and number of shares to be traded, then we can determine the amount of fund that is expected to be raised following this process. Okay, so it's easy to determine the amount of funds that will be raised if all issued shares are to be purchased. So this one is done at the primary market, which is a segment of the capital market. The entire raised amount would go to the issuing company. Remember, that's very, very important. And what will happen to the investment bank or any other bank or any other underwriter who will participate in the sale of those securities? They will receive commission following the sale. Okay, they will receive commission. Of course, all this information will be shown in the prospectus. All this information are found in the prospectus. So at your own time, you can just go in Google and look for a prospectus. They are out there, and you can read their number of information. Now, a primary market can be public market or private placement. Okay. Now, public market is for public issuance. Okay. Public market is for public issuance. Okay. What does this mean? At the public market, it means the financial assets is offered for everyone. Whoever have money can purchase them. At the public market or the public market issuance is meant for the entire public. Okay. So anyone can purchase. New stocks or new assets are issued. Investment banks are the one that involved much. However, as I just mentioned, also there can be some other financial firms or security firms. Okay. Now we can use this to issue government bonds like treasury bonds, municipal bonds. In our country, we do not have the municipal bonds. Okay, so we have treasury bonds. All right. Sometimes high regulated entities bonds, they can be issued there as the stocks. Okay. Now, What about the private placement? At the private placement market, securities are issued to a limited number of institutional investors. So at the private placement, okay, you all know the meaning of the word private, okay? So at the private placement, here it's not for everyone, okay? The issuance is not meant for everyone, it's not meant for the entire public, but it's for a limited number of institutional investors. Now, who are the institutional investors? Can be commercial banks, okay, insurance companies, and pension funds. Okay. Sometimes some wealthy individuals can be invited. Wealthy individuals, rich, very, very rich persons might be invited to invest under the private placement. So please remember, public issuance is meant for the entire public. Private placement is meant only for a limited number of institutional investors. Okay. So this is all about the primary market. The most important for you to remember is that there will be a specified amount of shares to be issued, let's say 20,000 shares, and there will be a price at which every single share will be issued, let's say 1,000. Okay, therefore the entire amount that will be raised here following selling of all shares, okay, this entire amount will go to the issuing company. Let's assume XYZ company is the one that has issued these shares. So the entire amount will go to XYZ company. XYZ company, the name will change to be XYZ Public Limited Company. That's how it's going to be. And the underwriter, if it's an investment bank or anyone, will receive commission following the sale of these shares. I don't want to get deeper into the IPO. That can be a subject for another time, but I think this one is enough at your level. Now, let's look at the secondary market. Remember, at the primary market, securities are issued for the first time. Securities are issued for the first time at the primary market. Now, at the secondary market, there we sell securities for the second time and so forth. Or it's the market that offers a platform for selling of existing financial securities or financial assets. In most cases, financial instruments are resold among investors. Okay. For example, let's assume at the primary market, Ms. Salema purchased 10,000 stocks of ABC PLC. Okay. At the primary market during the IPO, Ms. Salema purchased 10,000 stocks of ABC. Now, for some reasons, she wants to offload 500. Okay, she wants to sell 500 stocks. If this is the case, she can no longer go back to the primary market to sell them, rather the secondary market. So at the secondary market, should meet brokers. Okay, there are some security brokers. In our case, there is Orbit Securities, etc., etc. So the brokers will link Ms. Salema and any other investor who wants to buy stocks of ABC PLC. And the price will not be necessarily the same. Remember the other day I mentioned to you that shareholder can receive dividend, but also he can receive capital gain if he sells securities at a profit, and capital loss if he sells securities at a price which is relatively lower than the price he or she purchased during the IPO. So, what I meant here is that if, for example, she purchased these 10,000 stocks, each at a price of, let's say, 100 each. Okay, if she paid 100 for every stock, and then she comes to sell them at 120. Okay, this is the price. It means for every single stock that she will sell, she will gain a profit of 20 USD. This is capital gain. But if for some reasons ABC company is not doing fine, stock prices has declined due to a number of reasons, and therefore the current price for a stock is 80 USD. Then she will suffer a capital loss, okay, of 20 USD. This is capital loss. The most important thing here to understand is that you can buy shares during the IPO, but you can as well buy shares right after the IPO. IPO takes place at the primary market, and afterwards the remaining shares or existing stocks or shares will be traded at the secondary market. So at the secondary market, shares or stocks or financial instruments are resold among investors, and for that reason now the money that will be generated does not necessarily have to go to the issuing company. In our case here, if for some reasons Ms. Salema successfully sell these 500 shares at a price of, let's say, 120, it means she's going to earn how much? 60,000. So the 60,000 will not go to ABC. No. The 60,000 will go to Ms. Salema. That's the reason now we say no new capital is raised. The next market is the derivative market. Now, I need you guys to understand some concepts here to be able to correctly define the derivative market. Banks and other dealers and brokers customize financial forward agreements for their customers. Financial features in forward markets are also called derivative market. Why do we call them derivative market? Because any derivative instrument derive its value from the underlying security. I really need you guys to understand. Let me take you back. Let me take you back to the forward contract. This one will make life easier for you. Let me take you back to the forward contract. Okay. What is a forward contract? We saw that forward contract is a contract that gives right and obligation. It gives right and obligation for the holder of the contract to buy or to sell specified amount of currency, let's say 100,000 USD. All right. So the forward contract gives right and obligation for the holder of the contract to buy or to sell specified amount of foreign currency, let's say 100 USD, at a specific price. Okay, not any price, at a specific price, which we call the forward rate or forward price. So let's assume that Ms. Chiku has entered into an agreement with the National Microfinance Bank, where Ms. Chiku will sell to the bank USD 100,000, okay, at a price of 2,500. At a price of 2,500. Okay. When will this take place? 3 months from now. Let's assume on 30th of April 2023. Now, this is called a forward contract or a forward agreement. The agreement is between Ms. Chiku and NMB, where Ms. Chiku will sell to the National Microfinance Bank 100,000 USD, each at a price of 2,500. That is to say, on the 30th of April 2023, Ms. Chiku is expecting to earn how much? That will be 2,500 multiplied by 100. So you're going to end up with 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6, 7. Okay, so 250 million. That is what she's expecting to earn. But this will take place on the 30th of April 2023. Now, Chiku is supposed to hold this contract until maturity, and the maturity date is this one. However, she can decide to sell this contract. Okay, she can decide to sell this contract to someone else, to an interested investor. Now, if she wants to sell this contract, then she cannot take it to the capital market, nor the money market. She has to take it to the derivative market, because the forward contract is a derivative instrument. So she has to take this to the derivative market. Now, why do we say the forward contract is a derivative instrument? It is because the value, okay, the value of this forward contract is derived from the contract of sale of 100 USD at a price of 2,500. Therefore, this contract is worth 250 million Tanzania shillings. Without the underlying instrument, which is the sale of this foreign currency, then this contract is nothing. The value of the derivative instrument is derived from the underlying financial asset or instrument. That's why we call them the derivative instrument. The derivative market arises from a contract that pays obligation or other choice to buy or sell another something or buy some future debt. The something that is subject to the contract is called the underlying. Okay. So the underlying can be a stock, a bond, a financial index, an interest rate, or a currency. Okay, just like the example that I gave you before. Okay, a currency, for example, the selling of 100 USD. Sometimes can be commodity, for example, gold. Okay. Can be commodity such as gold. Now, because the price of such contracts derive their value from the value of the underlying, these contracts are called derivative instruments, and the market where they are traded is called the derivative market. Therefore, the derivative instruments are such as swap, forward. We covered forward. Okay. Future, also we discussed some future contracts when we talk about the forward. Options, remember options, we talk about currency call option contract and the put option, but also there is swap option. Also, yes, here is a swap, like you exchange the contracts, can be the currency or interest rate swap, and warrant. Okay. These are some of the derivative market instruments which are highly popular in the market. Now, what is a warrant? A warrant, just like an option, it gives the holder right to purchase a company's stock at a specific price and a specific date. So the maturity date needs to be determined and price also needs to be determined. So in other words, a warrant is a long-term option to buy a given stock at a fixed price. Such a type of warrant is called a call warrant. I think you guys remember the other day I told you with the option contract. With the option contract, there are two forms. Number one is the call contract, and number two is the put contract. Okay. A call contract is meant for you to buy, and a put contract is meant for you to sell. All right. Therefore, if you want to buy some securities, you go for the call contract. If you want to sell, then you go for the put contract. Likewise, with the warrant, okay, you can have, or we have a call warrant and also a put warrant. Call warrant is meant for an investor who wants to buy some stocks, or some securities, and a put warrant is meant for an investor who wants to sell. Now, there is a stock warrant and a stock option. A stock warrant is issued by a company straight to an investor. For example, XYZ PLC issues a contract to Miss Miriam. Okay, then this one is stock warrant. But what if Miss Miriam issues a contract to Mr. Abdullahi? Then this one is referred to as a stock option. Now, how do we use the derivative market? What is the importance of the derivative market? The derivative market is highly used for management of risk, and to be precise here, for hedging. Okay, the derivative market is relevant, highly significant for hedging. However, we also use it for speculation. Okay. Speculation simply means taking advantage of prices in order to make what? Profit. That's speculation. Like, for instance, an arbitrator might learn that a certain instrument has been underpriced somewhere and overpriced in another market due to some speculations, or if for some reason there's some speculation that a certain asset will decline in prices or rise in price, then a risk-lover investor might decide to take advantage of those circumstances in order to make a profit. That's speculation. But hedging is as well very important. Hedging is a risk mitigation technique. Hedging is a risk mitigation technique. Let me give you a practical example. Miss Chiku is a farmer. Okay, Miss Chiku is a farmer. She cultivates corns. Okay, and this year she will harvest more than 20 tons, okay, of corns that she has exported to Mr. Donald Trump in the US. Mr. Trump has promised that on the 30th of May this year will pay Miss Chiku a total of $400,000 USD for the export of corn. But remember, Miss Chiku is in Tanzania. She has not much use of the USD. That is to say, she will convert the USD into TZS so that she can have more money for preparing of next season of farming, paying wages, purchasing some farm tools, equipments, fertilizers, etc. But Donald Trump does not have TZS. Donald Trump has the USD, and so will pay in USD on the 30th of May 2023. Further, A financial advisor of Ms. Chiku informed her that there is a looming war between US and Russia following US assistance to Ukraine. And if this war will happen in March and April this year, most likely the USD will decline in its value. Today's exchange rate between USD and Tanzanian shillings is, let's say, 2,000 USD. That is to say, if you want to buy 1 USD, you need 2,000 Tanzanian shillings. If Chiku is to receive 400 USD today, okay, if Chiku is to receive 400 USD today, how much will that be in Tanzanian shillings? That means you need to multiply the 400,000 by 200,000. You're going to end up with how much? 8. 1, 2, 1, 2, 3, 1, 2, 3. That is 800 million Tanzanian shillings. That is if Chiku had to receive this money today. However, Donald Trump has promised to pay on the 30th of May 2023. That is 2 months after the beginning of the speculated war. Now, Ms. Chiku can decide to protect these proceeds from loss, because if USD will decline from 2,000 to anything below, let's say 100, 980, she will incur some losses. She won't be able to gain this 800 million. Now, she may decide to approach one of the commercial banks in the country, for instance, the National Microfinance Bank, and enter into a forward contract where Ms. Chiku will sell, okay, Ms. Chiku will sell the 400,000 USD to a bank. And let's say now the agreement is that Chiku will sell this amount, okay, this USD at a price of 2,000. So she decided to lock the same price of 2,000. Now, on maturity, which is the 30th of May, Mr. Donald Trump pays, okay, on maturity, which is the 30th of May, Mr. Donald Trump pays. Mr. Donald Trump pays the 400 USD. However, on that day, the exchange rate of USD against TZS has declined from 2,000 to Tanzanian shillings 180 for every single dollar. So the dollar has lost value by 200. It means Ms. Chiku, if had never entered into a forward contract, would have lost 200 USD for every, 200 Tanzanian shillings for every single USD that she will sell to the bank. Okay, the loss will be, one moment please. So in this circumstance, she's going to earn 720 million. So you can see here, there is a loss of 80 million. This is a loss. But since she has entered into a forward contract, where she locked the price of the USD at 2,000, it means she has managed to cover herself against the loss of 80 million. Okay, that means this loss here is covered. She will never suffer this loss. Why? Because instead of selling the USD at the market price of 1800, she's gonna sell at a contract price, the forward rate of 2000, and thus she has mitigated this risk. That is what we call hedging. So the derivative instruments are very useful for hedging purposes. Okay. Also, we have what we call the exchange market. Okay. Now, what is the exchange market? Exchange market is where buyers and sellers of financial securities meet in a centralized location, okay, to carry out trade. All right. I'm sure you guys must have heard about, for example, the New York Stock Exchange, okay, the NYSE, plus some other exchange markets. Okay, these markets have a centralized location where investors go over there, they meet and start trading. Okay, so if the market is centralized, localized, then it becomes, or it's known as the exchange market. Now, in most cases, still an investor will need an assistance of a broker or a dealer in order to carry out trading at the exchange market. But the opposite to this market is the over-the-counter market. Over-the-counter market is abbreviated as the OTC. Okay. Now, over-the-counter market, this one has no physical location. Now, how do they trade? They meet or they trade through the usage of sophisticated communications medium. Can be telephones or the internet. Right? So buyers and sellers or participants of this market utilize the available sophisticated communication network, telephones, and internet in order to trade. No centralized location. This is the over-the-counter market. Last, let's discuss the functions of the financial market. What are the functions of the financial market? Number one, financial market facilitate price discovery. Right now, if someone asks you, what is a price of a stock of Apple Inc., the manufacturers of MacBook and iPhones? Most likely, we don't know. But if you Google or if you visit any of the financial market, you will find the price or the prices have been listed. So any listed company, the price of the stock of any listed company can easily be obtained or discovered at the financial market. Again, if you want to know the price of a share for National Microfinance Bank, CRDB, etc., just visit any of the financial market. You can easily learn this. Liquidity. Okay. Financial markets provides liquidity. How? Because if you are in some liquidity crisis, you simply have to visit the financial market and sell some securities. If you sell some securities, investors will buy. That means investors will give you money and they will take securities or financial assets. And thus, liquidity is provided to the economy. So financial markets provide liquidity to the economy. But also, financial markets reduce transaction costs. Remember, in any given economy, we have the deficit spending unit and the surplus spending unit. Okay, surplus have money, right? Deficit spending unit have no money, right? Now, if or in absence of the financial market, it will be difficult for the deficit spending unit to determine who to go and borrow or get some money. But the presence of financial market has reduced this task. Like instead of roaming around looking for someone to borrow you some money or looking for someone to sell some financial assets, all you have to do is to visit the financial market. If you visit any of the financial market, for instance, online, you will lower searching costs as well as information costs, because all information about investors, listed companies, traded assets are displayed at these financial markets. And thus it becomes easier for you either to sell or to buy securities. Financial markets produce an efficient allocation of capital. Some individuals have a tendency of keeping money in their household, in their houses. Some even dare to bury the money in the ground. That money becomes idle, does not generate anything, does not produce anything. But if you are to go to the financial market and you buy some securities that are offered by the deficit spending unit, what will happen? A win-win situation. How? You give money to a deficit spending unit, let's say Apple Inc., and Apple Inc. will give you a financial asset, let's say a bond. After every 6 months, Apple company will pay you the required coupon payments. Likewise, Apple will use the money that you have loaned them to produce or to launch some new products, such as the new mobile phones and laptops, of which again these are going to offer to the market for sale. So some new jobs will be created, you see, and ultimately we are going even to see the economy booming, okay, high economic growth, because capital is available, market for produced goods is available, a win-win situation. You get, they get. You win, they win. But if you bury the money in the ground, that won't be a win-win situation, because your money will never generate anything, simply because it's an idle fund. That marks the end of this brief presentation. I thank you very much for your patience.